Macro, macro, macro. It's all back. The election dust is settling, and the focus is once again on the main story that has been with us for months and quarters in the macro world, the Fed, interest rates, and where that will take financial markets. Appropriately enough, this is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is look at the next big inflection point in this story, which comes to us in less than 24 hours by way of U.S. inflation data. This will be the timelier of the two, the CPI report, the Consumer Price Index, and how the markets are already positioning for it is perhaps suggesting where we are going to go next, or at least how this is setting up going forward. And the implications don't look particularly rosy. So what we're going to do here is take a look at what is expected, take a look at how that fits into the narrative as it presents itself, and then figure out how these markets might respond if they haven't done so already. And if they have, what does that mean? So here's what we are looking at in baseline forecast. The headline inflation rate is expected to inch up to 2.6% year on year in October. That would be the first uptick since March. The core rate, which excludes volatile food and energy, and of course is the focal point for the Fed because they can't very well hope to influence global food and energy costs. Indeed, we can see that all of the inflation at this point is pretty much baked into core services. That rate is expected to hold steady here for a second consecutive month at 3.3%. Now, that somewhat obfuscates that we've actually seen the grinding to a halt of the disinflation process. If we get this 3.3% broadly as expected, we'd be looking at the fourth consecutive month that prices have not gone down. Now, the last time they went down was in June from 3.4 to 3.3. They went down again in July to 3.2, and since then, progress has been arrested. June was a repeat, or August rather, was a repeat of July, 3.2. We went up to 3.3 in September, and if we stay at 3.3 this go round, well, then we've stopped to progress for a fourth month. And from the perspective of the Fed, this, of course, represents a potent risk to perhaps missing, or at least to getting off course relative to their inflation target. And so, in so much as we've seen this movie before, we heard from the Fed in similar circumstances at the beginning of the year, when an upswell in the U.S. economy gave us a shift in rate cut expectations to a more hawkish setting. And the Fed in May bemoaned that there were 3 months of consecutive standstill and a lack of progress in their own words. We saw that in June, the Fed watered down their estimates from 3 cuts in 2024, which of course in practice have already been delivered now. But at the time, the Fed was unsure and cut it back from 3 to 1. So this is exactly the kind of set of conditions that might give the Fed some pause. And indeed, the priced in probability that we are going to get a further rate cut in December, which as recently as a week ago looked like pretty much a done deal. A week ago, the markets priced in the probability of that cut at 77%. A month ago, it was even higher, 84%. Today, it's 58%. And so we've seemingly gone to a place here where the market didn't quite revert to 50-50, but is increasingly approaching it. 58% chance that we don't, or that we do have a cut, and 42% chance that we don't. So still narrowly in favor of that cut, but certainly a lot less conviction in it. And that lines up because, of course, what we've seen out of the U.S. economy before we start a conversation about the election, before we start a conversation about its inflationary implications that the markets have been toying with already, we see that since late August, U.S. economic data has increasingly improved relative to forecasts, which in simple terms means that whatever baseline market economists had for the path of growth, for the path of economic activity, was weaker than reality has endorsed. Moreover, not only has reality endorsed a stronger vision, the gap has actually accelerated. So we can see here, on this index, 0 is the dividing line between tending to surprise lower and tending to surprise higher on realized outcomes compared with expectations. The quotient for downside surprises begins narrowing first until you get to 0. And the economy shows itself to be about in line with expectations. But then it starts to accelerate and power higher. So not only are we in a place where the U.S. economy is telling us that the markets expect weaker conditions than they're getting, but the gap is widening, which is to say the economy is pulling further and further away, and expectations are struggling to keep pace. The models that economists use to generate economic forecasts are not being adjusted adequately, as it were, to capture the level of vigor and the level of momentum in the economy. So it seems hardly surprising that rate cut expectations are falling away. Indeed, if we look at the way things are calibrated now, we are looking for 2 cuts next year. That's, of course, a far cry from the Fed's own expectation of 4 when it gave us the policy update and the forecast update in September. The view for the rest of this year is only 12 basis points being baked in, implying that we are right around that 50-50 mark on whether we're going to get another 25 basis point cut in December. It's basically a coin toss here. About half of it is baked in, give or take. And so we have very clearly seen that the outlook has grown progressively less dovish. In fact, if we take a look right here where we are on the outlook for next year, the last time that we were this shallow was actually all the way back here. Now, of course, this is where the tail end of this these yellow bars are. Needless to say, this is cuts, so this axis is going negative. So the reference point for this is all the way back here. We are essentially reset to where the outlook for U.S. monetary policy was before this wave of dovish readjustment back in mid-April or so. Now, this is a very interesting spot because, of course, that's also right here where we saw an upswell in U.S. economic activity at the start of the year. That gave us this readjustment where we went from looking at maybe as many as 6 rate cuts down to 3, with some perhaps erring in the direction of 4. we've basically reset to that now before what then became a turn down in U.S. economic activity here, this move here, that gave us this dovish readjustment. So we've basically come full circle. Now, the U.S. economy certainly looks chipper, and fewer rate cuts against that backdrop do seem to make sense. Here's the latest set of U.S. PMI numbers from S&P Global. We can see that for the composite index, which takes together services and manufacturing, the strength in services has been strong enough, not surprisingly, by the way, all of the inflation is in services. It gives you a sense of where the demand is. All of the strength in services has given us how the economy is basically holding at a 12-month high established back in May. It hit this 12-month high then and has since idled right here, essentially suggesting the economy is keeping at a brisk pace and sustaining it. The ISM version of PMI data is even more dramatic. We can see this latest set of numbers from ISM, especially on the service sector. Both versions, the S&P Global version and the ISM version, give us anemic manufacturing, but it's services, again, where the boom is. And here, since mid-2022 is the reference point for how strong at this point the service sector looks. So it does seem to make sense that in this environment, there is a degree of readjustment in Fed policy expectations to a less accommodative vision. And indeed, if the data surprise dynamics we've seen, if these dynamics that we've seen set us up for any kind of surprise risk, it is that these numbers actually end up hotter than expected. And if they do, then certainly for the Fed, this is already a moving issue. If we look at the annualized rates of inflation that the Fed looks at to get a sense of sequencing, consider here that the 3-month annualized CPI rate has been going up since July. In July is where it hit its lowest, and since then has actually ticked the wrong way. If we look at the core 3-month, and again, this is the higher frequency reading annualized, this is what the Fed looks like it seems to evaluate. They don't obviously make it transparent and clear saying we're looking at this one number, but they seem to reference these things both directly and indirectly quite a bit. The 3-month annualized rate in the yellow here for the core, likewise, since July, starting to go higher. And indeed, in September, hits the highest level that we've seen since back here in May. Again, referencing that mid-year shift in the economic regime that we just saw. All of which is to say that the Fed, when it looks at higher frequency numbers, is saying the pace of inflation is trending in the wrong direction. The 6-month core rate has stopped declining. That's the green bars here. And the higher frequency 3-month one is going up. At the headline, the 3-month rate is going in the wrong direction. The headline is still declining. You can see these red bars are still inching lower. But that, looking at the makeup here, seems more to do with the downdraft from goods and even more so the downdraft from energy. And isn't the kind of thing that the Fed would hang its hat on. So the question then becomes, well, let's say we do get an upside surprise in this data in line with how things have behaved recently. What does that mean for the markets, which have already taken some steps today with higher yields and a stronger dollar and weaker gold to signal that they're starting to position for a hotter inflation number? Well, we look at the way that the Cleveland Fed's nowcast model has performed recently, we can see that even just in the most recent set of numbers from August into September, a little bit of regime change. The model for headline inflation was running a bit hotter than realized results until September. Same thing with the core. The model was running a bit hotter than realized results, that's in the red here, until September. Both models envision an uptick. So that much is probably not a source of concern for markets, and perhaps they've already made their move with today's adjustments on that basis. But if this continues to run hotter than what is basically the market's loose benchmark, if we continue to get these surprises on the top side, as we apparently seem to be liable to see, again, right here, then a still further dilution of rate cut expectations into next year seems likely, where these yellow bars get even shallower and even more dovish intent is factored out. Where this is the most clear seems to be the US dollar. In the green here is the US dollar's average value against its major counterparts. And you can see here we're shifting very clearly in line with sort of the ebb and flow of policy expectations. There's a bit of a disconnect right here, but we snap back quickly. And as the speculation grows hawkish, or in relative terms, of course, another way to say it might be less dovish, the dollar gains, and of course it has been a key beneficiary of this change as well. So if we do get a hotter than expected CPI number, this probably has another bit of upward momentum in it. But the big question, not surprisingly, of course, is stocks, which have had periods where they're impervious. That period at the beginning of the year, you'll notice, has rate cuts falling away, but stocks are able to march higher all the same. Incidentally, as a disconnect from where the two things moved inversely toward the end of last year, seemingly suggesting you could convince stock markets that as long as growth were all right, higher rates and fewer rate cuts need not be detrimental. We saw something similar here. Stocks are going up. This is getting less dovish, but momentum is maintained. The real question is, have we arrived at some kind of a breaking point? Because whereas here, the global economy as a whole was accelerating, here, only the U.S. economy is accelerating, whereas the global one is growing at some of the slowest rates in 8 months because Europe is anemic and China can't get off the mat since exiting COVID restrictions. Higher U.S. rates mean higher rates globally because of the ubiquity of the U.S. dollar and global commerce. And if global economy conditions are deteriorating on the whole, higher rates is not what's needed. And risk aversion may come even if the U.S. looks robust. So this may well be a critical and decisive point for stock markets. If we get a hot CPI number that gives us a stronger view on rates going forward and stocks do decline, well, then a very important regime change will have been signaled. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm on the Price of Truth with Victor Jones. I'm on Futures Power Hour with Chris. I'm on First Call with Victor and Tom throughout the week. I'm likewise writing for the News and Insights portion of tastylive.com and commenting sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for watching. Happy trading. Macro Money's back tomorrow.